Afternoon, everyone. This is Terry HORAN, and welcome to our fourth economic update on the markets and how they may impact you. We continue to host this webinar on Fridays at 2 o'clock to share HORAN's financial perspectives until we come through this era of uncertainty. We're recording the session, and so be sure to share it, and we'll share that with you today. Please send it to your friends and relatives and anyone else you can think of. As you know, let me first update you on HORAN. We're open and have asked most of our staff to work from home through the governor's new order of May 1. Several of us are here in the office today, but I can assure you we are socially distancing, and I am wearing a mask around my neck at the moment. Accessibility is a top priority and will continue to be diligent. We have a landing page on the HORAN website that serves as a hub of COVID-19 resources to support you and your employees. To date, we've made, in this week alone, we've made 1,400 client calls and emails out to solve issues for you and to provide information. Our fundamental that we have this week, and there are 27 of them total, is find a way. Well, we're finding new ways to communicate with you each and every week, and we hope that they're being effective. Please call us with any suggestions to do this better. When we first started this webinar 4 weeks ago, on March the 20th, the S&P 500 was at 2304, and today it's at 2789.82, a 21% increase. The Dow was at 19,173, and today it's at 23,437, a 22% increase. So I'm not going to take all the credit for the market lift, but we're going to take a little bit of it. More sobering, however, is the COVID-19 cases on March the 20th were 18,747 people in the United States with identified COVID. Today, on April the 9th, it's 427,000 people. Abraham Lincoln once said, "I have a firm belief in the people. If given the truth, they can be depended on to meet any crisis. The great point is being there with the facts." Well, today, as usual, we're here with the facts, and I have a great team with me to help me on this. Paul Carl, with 33 years of experience, 8 of which with the Department of Labor. Mike Napier, serving clients to help craft detailed financial plans and coordinate investment strategies. David Templeton. David is a CFA and a managing partner of HORAN Capital Advisors with 30 years of experience in the financial services industry. Greg Hornschmeyer. Greg and I have been together for many, many years, and he serves as a personal advocate and insurance consultant for individuals and companies. And finally, Matt Antonucci, another CFA with HORAN Capital Advisors, responsible for meeting investment and planning needs. I'm going to go first with a short little Washington update if I could. I've been on the phone with them several times, with many people in Washington several times this week. And we anticipate the individual payments to people of $1,200 or $2,400 to families and extra money if they're children will go out beginning next week. We have some assurance on that. I think, and they're following, if you have a automated checking account, it will be put in your checking account. If not, they're going to mail you the cash to your homes. You might want to check with your accountants or with the IRS to make sure that they've got the right information. We also know that the SBA money that was put into place 2 weeks ago is $349 billion. Congress has been very willing, and Secretary Mnuchin would like this to happen, to approve an additional $250 billion for those business loans. This has become somewhat of a political football in Congress at the moment, as some people would like to add additional money, stimulus, for hospitals and food stamps and other at-risk individuals. So what could have been a voice vote by the end of this week will now be delayed perhaps till next week or the week after, which I think is really quite a shame. And finally, there is potential for stimulus package number 4, but that will probably not happen until after May 1, when we see the impact of what has already been put in place. However, David Templeton is going to tell us about some additional stimulus from the Federal Reserve. And so at this point, David, I'm going to turn the talk over to you.
Thank you, Terry. What I'm going to start out with is we've done this during the week is on this next slide, we've started with kind of a view of the last 5 trading days. So it'd be Friday to Friday or Friday to Thursday. So you can see here the market's had a nice return for the week. It's actually up 10.2% for the 5 days. If we look at Monday through Thursday, which was the 4 days, it was the best week since 1974. It was up 11.7%. As Terry mentioned in his opening remarks, the low on the market was March 23rd, actually, and it's up about the S&P's up nearly 25%. So it's been a strong bounce from the low. On the next page, on the next slide, we can see the sector performance for the S&P 500. The yellow lines there are the year-to-date performance. This is through Thursday's close. The blue lines are the performance of the sector since the low on March 23rd. The worst performing sector year-to-date has been the energy sector, and there's been some other things going on with that sector, and it's contributed to the market volatility. It's down 41.8%. Since March, it's up 45%. The other sectors you can see there from the worst performing sectors, financial, industrials, and materials, but they've had some of these poor performing sectors have had nice recoveries from their lows. It should be noted, fewer than 40% of S&P 500 stocks, though, continue to trade or trading above their 20-day high. So it's actually been a fairly narrow recovery from the market low here. As we go along here, you're able to type in some questions if you have them. But before we do that, I'm going to turn it over to, and we'll look at those and try to answer any those as they come in. But Matt, would you like to talk about some of the segments of the market?
Absolutely. Thanks, David. So one more highlight on the week is that the Federal Reserve announced that it will aim to provide an additional $2.3 trillion in financing to businesses, primarily small businesses, where payments will be deferred for a year. And the Fed also remarked that it's going to start buying corporate bonds that are rated investment grade as well as junk. And that's important because the corporate bond market, specifically on the lower quality end, had been hit hard during the sell-off. And the Fed, with this action, starting to alleviate some of the credit and liquidity concerns in these markets. And so as a result, on slide 7, we see that the corporate bond market got a boost from this. High yield or junk bonds, the black line, were up 6.5% on Thursday. Investment grade corporate bonds were up 5%, that's the red line. And then bank loan bonds in the blue were up over 3%. So investment grade corporate bonds are now positive on the year, and high yield and bank loans are not far from even, which is quite the recovery from the depths of the decline.
So Matt, on the high yield bonds there, they had one of their best, I think it was the third best performing day for that index. Is this justified in terms of what the Fed's announced?
We think the market might be being a little presumptuous here with some of the snapbacks, especially in the high yield market. None of the bonds in the high yield index that we're showing here are bonds that the Fed will actually be buying. The Fed, if you kind of look at the fine print, the Fed's going to be buying bonds and junk-rated bonds that had been downgraded since March 22nd. So the market, or this index in particular, might be a little presumptuous in the move higher.
It may be a sign of some of the speculation that's in the marketplace at the moment, potentially.
Yeah, absolutely. Absolutely.
David, I have stimulates another question, and that is, I appreciate what Matt said about the bond market. So are we seeing somewhat of a bottom on the equity market, do you think?
We do think the bond market's pretty smart in terms of, it's probably smarter than the stock market. And that may be an indication that, there is some bottoming process taking place here in stocks. And I think Matt's going to touch on something here in just a second.
Feeling your thunder, Matt.
No, but We don't think we're necessarily off to the races here at stocks, though.
Okay.
That's a great segue, actually, into the next slide. Are we out of the woods yet? And to help answer that, we look at previous bear markets and the rallies that have occurred within those bear markets. So this table on slide 8 is from LPL Research, where we're looking at 11 bear markets that have occurred since World War II, including the one we're experiencing. And on this table, there's a couple of things to point out. So first is the number of months in each bear market in the middle column. And then the last two columns show the total return of the S&P 500 from top to bottom, and then the largest bounce that occurred on the far right-hand side in between the top of the market and the final low for each of these periods. And so a couple of things to note and compare to our current situation. The first is that the average length of the bear markets here is 14 months. So bear markets usually take longer to resolve, and our most recent bear market's just been a little bit over a month and a half. So it's been a swift trip down, maybe not over, we'll see. The second thing to point out is that the return, the average return from top to bottom is around 34.2%. And we dropped 33.9%, as we're showing towards the bottom of this table, from top to bottom, which is just about in line with the average. But then on the far right, we can see the biggest bear bounce for each down market. And on average, the market rallies 13.7% during a bear market before resuming lower. So, looking at this table, historically speaking, strong rallies during a bear market are common, and it's happened in every single instance. And this chart is as of March 30th, so it doesn't show the latest data, but for contrast to our bear market, we've rallied, some 25% from the low, much stronger than previous downturns. Some people are saying that this is a new bull market. Maybe that's a little too early to say, but it's important to note that, what isn't shown here is that we typically get a retest of the low or some period of consolidation. It's not typically just straight down or straight up action.
So we might be forming a bottom.
Yeah, we could be forming a bottom here, absolutely.
Yeah.
With that said, we have over 16 million people filing for unemployment in the last 3 weeks.
Yeah.
So some people might be asking, how could we possibly be rallying when all these things are happening?
Right.
And one possible reason for that is that the market's a forward-looking mechanism. So the stock market or stock prices actually tend to lead the general direction of the economy. And if we look at the next slide, this is again from LPL Research. We're examining the last 12 recessions since 1945, and kind of similar to the last slide, you can see the length of each recession in the middle column, and the average length is 11 months. If you look to the far right, it shows how far in advance the S&P 500 tends to bottom before or after the end of a recession. And we see that in 11 of the 12 cases, the market actually bottoms before the end of a recession. And it bottoms on average around 5 months before the end. The only time it didn't happen was 2002, and that might have had something to do with the excessive stock valuations that we had. But the point remains that the equity market tends to lead the direction of the economy, and we can expect that this might not be the case, this time. But good news in the economic data, we might not be seeing, but the market might start to price that in at some point while we're making a bottom.
Matt, we were having a little discussion before the webinar started, and the market is up significantly this week in the face of very bad news. Greg, you had a stat on the number of deaths.
Yeah,
as a result of the virus.
I've been watching this on a daily basis, and just out of my own curiosity, and since last Friday, the number of cases worldwide has increased by 600,000. The number of deaths just last week worldwide are over 45,000. So it's pretty alarming how this thing keeps growing. We keep talking about the curve and when that's going to flatten out.
Yeah, but it again supports what Matt was saying, that the stock market is a forward-looking
Absolutely.
institution.
Well, and the amount of the stimulus that the government is just throwing at this, at the situation is just unprecedented.
Yeah.
I mean, just yesterday, the Fed threw out another almost $2.5 trillion, right? It's just amazing.
Pocket change.
What's that?
Pocket change.
Pocket change.
Trillion here, trillion there, finally it adds up to some money.
Hopefully there'll be some infrastructure money in there at some point, but,
I agree with you on that one, David. It's surprising to me that infrastructure is yet to be named for all this.
right.
Dave, what do you guys think? Are you hearing anything about the restaurant industry obviously getting killed? Is there anything in the stimulus package in this new round that they're going to help restaurant owners out?
Well, the one thing that is anticipated to help them, there are two things, the SBA loans to help them, to provide some, it's basically grant money, loan money that will cover their payroll for a couple of months. That is the key variable that they're trying to put in place to protect a lot of businesses in hopes that when we open up the economy, these restaurant owners and their businesses and the employees will still be intact, and it'll be a fairly quick opening. Now, they're all not going to probably survive. The longer it goes on, the more difficult you see a quick snapback.
Well, David, there's another aspect to that, safety net, I think, for restaurants, in that furloughed employees can get almost as much as $50,000 in unemployment benefits in a combination of regular unemployment insurance and this additional federal stimulus money. And so that can keep a lot of furloughed restaurant employees going while
Right.
this comes through. So,
And not only restaurants,
Right.
manufacturing and a lot of different
Absolutely.
companies, sure.
Absolutely. Yeah, two tranches to it. Paul, we need to hear some of the details of how these rules are working.
Yeah, I'm happy to provide them. So the mention of furlough is actually a great segue into my first topic today, and want to talk about defining the terms of separation of employment. And what I want to highlight in particular is furlough versus layoff. So first of all, I'm going to tell you that the information I'm providing is general in nature. The rules vary, especially for union versus non-union, and even further. And I'm going to make a strong recommendation that if you are a business owner in particular, you consult with legal counsel on this. But we're hearing furlough and layoff used interchangeably, and I thought maybe some defining moments here would help explain things. So furlough is essentially a temporary unemployment situation. At least there's an intention that it's temporary, that, as soon as possible, furloughed employees will be able to return to work. Now, what's nice with furlough also is a lot of employers are able to continue some of the benefits, especially health benefits during this time. A layoff is really an intention that we don't necessarily want to terminate employment, but there's a reason, most often some type of economic reason, and we just don't know that an individual laid off will ever be able to return to work. We'd like for them to, but something's happened and we just don't expect to bring them back. And generally with a layoff, benefits, especially healthcare, will discontinue. Now, obviously, COBRA can be picked up, but that's paid individually and can be quite expensive. I do want to point out that technically furlough and layoff, neither is termination of employment per se. Obviously, the layoff is a little bit closer to that definition, though.
Thank you. Yeah, keep going.
Yeah, and the next item I'd like to talk about is the CARES Act and student loans. Terry, we've been getting a few questions about this, and I think a lot of it stems from an interest over the last couple of years with regard to using retirement plan assets and student loans and how they could interact. And as we know, there's been lots of asks out there to get more legislation around student loan payments, but nothing really concrete has happened. So the CARES Act, interestingly, threw in a little provision there, and an attorney this week called it maybe a trial run for something permanent. But what it boils down to is through the CARES Act, employers can make tax-free student loan payments on behalf of their employees. So Generally, you know, employers will sponsor a Section 127 educational assistance plan. This is a taxable benefit to those individuals that take advantage of it. So what the CARES Act is doing is making this benefit non-taxable through December 31st of 2020. So it's a temporary item. You know, obviously with the economic upheaval, whether or not employers can afford this, you know, who knows? But it was thrown into the CARES Act. And again, I kind of like the fact that maybe this is a little bit of a trial run for future legislation down the road in the student loan sector.
Good. Paul, thank you. Did we have any questions from our public?
We answered some of them along the way.
Yeah, we did answer a couple of
Larry,
them.
one question just
Yeah.
had before we got down here, it's not an interesting, little tax update about the, income tax. Obviously, you don't have to pay tax this year until July 15th, but I thought I read that the estimated taxes due June are now due until July as well. Is that correct?
I think that's correct. We're going to publish that list. I got a whole list of what our delays are from Washington, and we'll put that up on the website for all of you to see. But it's
That'd be great.
it's a laundry list of things. So I think we're going, because of the holiday, we're probably going to wrap this up a little sooner than we normally do. But I want you to know that we're going to keep doing these on Fridays at 2 o'clock, and look on our websites for additional webinars and podcasts through the week. We did two webinars this week, and we also did a podcast, and we will continue to do that for you. Thank you, David, Michael, Matt, and Paul, and Greg for being here today. And thank you to our public for trusting us to be your advisor. If others want to watch this or listen to this webinar, we will make it available to you. Happy Passover and Happy Easter, everyone.